Hey everyone, if you're prepping for any of the big banking exams, you know that every single mark counts. That's why today we're diving deep into a topic that's pretty much guaranteed to pop up, the RBI's brand new rules on co-lending. We're going to break down every key number, every rule, everything you need to know. Let's get right into it. So to get our heads around this, let's just imagine a situation. You've got a huge bank in Mumbai, right? They've got the money, but maybe not the reach into smaller towns. Then you have a local NBFC in one of those towns. They know everyone, they have the local connections, but they just don't have the deep pockets. So how do you get these two to work together on the same loan? Well, that's the exact problem that co-lending is here to solve. Okay, here's our game plan for today. We'll start with the big picture, get the basics down. Then we'll look at who can actually participate. And trust me, that's a classic exam question. After that, we'll get into the really core rules and numbers, how it all works day to day and how risk is managed. And I want to stick around till the very end because I've got a fantastic cheat sheet for you that's perfect for that last-minute revision.
Right, so let's start from the top. Section 1, the big picture. What is this whole new framework? And, why did the RBI even bother to introduce it?
Let's get the official jargon out of the way. It's called a co-lending arrangement, or CLA. For your exams, just remember it's a deal between two regulated entities, like a bank and an NBFC. And there are three key phrases to highlight here: jointly fund, pre-agreed proportion, and sharing both revenue and risk. It just means they decide everything up front, who puts in what, and how they split the profits, and, importantly, the losses if things go south. So why the new rules? Well, the goal was really twofold. First, the RBI wanted to create one single, clear set of rules for everybody to follow. No more confusion. And second, they wanted to broaden the scope. Before, co-lending was kind of stuck in just priority sectors like agriculture. These new rules really open the door for it to be used for all sorts of loans, making the whole system way more organized. Okay, moving on to a section that the people who set your exams absolutely love: applicability. Let's get super clear on who can be a part of these co-lending deals, and just as important, who's been left out. So the rules apply to three main groups. First, commercial banks. But, and this is a big but, pay attention to the exclusions. Small finance banks, local area banks, and regional rural banks are not included. Got it? Okay. Second, you've got your All India Financial Institutions, or AIFIs. And finally, all non-banking financial companies, the NBFCs, which, yes, also includes housing finance companies. And we need a good trick to remember this stuff for the exam. Just think of the word can. C for commercial banks, A for AIFIs, and N for NBFCs. Simple, right? These are the players who can participate. It's a really easy way to lock that answer in for any multiple choice question. Now, just as important as knowing who's in is knowing who's out. The RBI has been very specific here. These new rules do not apply to multiple banking arrangements, consortium lending, or syndication. These are totally different beasts, and they have their own set of rules. Don't get them mixed up. And of course, we've got a mnemonic for the exclusions too. Just remember the letters MCS. M for multi-banking, C for consortium lending, and S for syndication. A silly way to remember it, just think, my course syllabus doesn't include MCS. It's a bit goofy, but hey, if it works, it works. All right, now we're getting to the real heart of it, the numbers, the core concepts that you absolutely need to know. This is what makes the whole thing tick. Okay. Here's a number you have got to burn into your brain: 10%. The RBI says that each partner, each lender, has to hold a minimum of 10% of that loan on their own books. Think of it as the skin in the game rule. It makes sure that both lenders are seriously invested in making sure the loan is a good one and gets paid back. 10%. Remember it. The next really key idea is something called the blended interest rate. See, the borrower, the customer, they don't have to worry about two different interest rates from two different lenders. Nope. They just see one single final rate. And this rate is basically a weighted average, calculated based on how much each partner chipped in and what their individual interest rate was. And this table here shows you exactly how that math works. It's pretty straightforward. So let's say the bank funds 80% of the loan at 9% and the NBFC covers the other 20% at a higher rate of 12%. You do the weighted average math and boom, the borrower gets one single blended interest rate of 9.6%. It just keeps everything super simple and transparent for the customer. Okay, so we've covered the what and the who. Now let's get into the how. What are the actual nuts and bolts? What's the day-to-day process that makes one of these co-lending arrangements actually function? Here is another number you need to highlight in your notes. 15. 15 days. After the loan money is given to the borrower, the main lender has a maximum of 15 calendar days to transfer the partner's share of that loan over to them. It's a strict deadline, and it's there to make sure everyone's books are squared away nice and quick. So this little chart here basically shows you the whole life cycle. It starts with one of the partners finding the customer and checking them out. That's sourcing and underwriting. Then, step 2, the full loan amount is paid out. Then comes that crucial loan share transfer, which has to happen within that 15-day window we just talked about. Now, step 4 is super important for the customer. They only ever have to deal with a single point of contact for the entire loan. And finally, all the repayments they make go into a special, neutral escrow account, which then splits the money correctly between the two lenders. A smooth process is one thing, but what happens when things go wrong, when a borrower can't pay? Let's look at the safety nets and the really strict compliance rules the RBI has put in place to manage risk. And here we are, our final key number for the day, 5%. So, the lender who brought in the customer can offer a kind of guarantee to their partner to cover any losses from defaults. But this guarantee, which has a fancy name, a default loss guarantee, or DLG, is capped by the RBI. It cannot be more than 5% of the total loan portfolio. So, just to be perfectly clear on what a DLG is, think of it like a limited insurance policy. The main partner says, hey, don't worry if this loan goes bad, I'll cover some of your losses. But that promise has a hard stop. It's capped at that 5% limit set by the RBI. Now listen up, because this might be the single most important rule in this whole framework. Asset classification has to be uniform. It's done at the borrower level. What does that mean? It means if one of the lenders decides the loan has gone bad and classifies it as a non-performing asset or an NPA, the other lender must automatically do the exact same thing. No arguments, they are essentially chained together on this, which ensures everyone sees the risk in the same way. Phew, okay. We have covered a lot of ground. So, just as I promised, here is the ultimate revision slide. Seriously, get your phone out right now because you are absolutely going to want to screenshot this for your final prep. All right, let's do a super fast recap of everything you need to remember. Ready? Minimum share for each lender, 10%. The loan transfer window, max 15 days. The DLG cap, 5%. The interest rate for the borrower, it's blended. Asset classification, always uniform at the borrower level. Who can participate? Remember can? Commercial banks, AFIs, NBFCs. And who's excluded? Remember MCS, multiple banking, consortium, and syndication. This one slide is your golden ticket for revision. So, I'll leave you with a question to think about. The RBI has definitely laid out a much clearer, much more organized path forward here. So the big question now is, will this new and improved co-lending model become a real engine for credit growth across India, especially in those priority sectors? It's definitely something to keep an eye on. Thanks so much for joining me today, and truly all the best for your upcoming exams.